Hi, this is Colleen Murphy, and I'm just going to talk a little bit, although you've probably heard a lot about this already, about the modified adjusted gross income piece of eligibility determination. A lot of these slides you've probably already seen before, but given it's kind of the bedrock to eligibility determination to figure out what somebody's income is and household composition, we wanted to make sure that we went over it again to hopefully make sure everybody's comfortable with it and all the pieces included to figure out how much income somebody has and what level of the federal poverty level they fall under. So on slide 65, we start out with modified adjusted gross income, MAGI. We want to make sure that everyone understands that there are two pieces to MAGI. It's a methodology that uses federal income tax rules and concepts, and it's used to determine somebody's income and count what their income is, but also determine their household composition or family size. So this is different than what we're used to today for Mass Health and ComCare income determination. We're using gross income today, but moving forward it's going to be taxable income. So federal income tax rules and concepts of adjusted gross income with some modifications, that's where the M in MAGI comes from. They're used, but it's not simply a number off the tax return. Include on slide 65, we do have the final Medicaid and CHIP rule, the regulation there, and also the section of the Internal Revenue Code that's used to determine what's taxable income and what isn't. So the next slide, slide 66, goes over what MAGI household composition is. There are some differences here between premium tax credits and Mass Health determination for household composition. Under MAGI, the definition of household composition is different than what it is that we know today. It's one of the biggest changes and things that's a little more unpredictable than other parts of eligibility than what we're used to. In today's world, we look at a family group to determine household composition, and it's usually, the people who live in the same house and are related to each other are considered a family group. But under MAGI, there's no longer going to be one family group, but rather each individual will have their own household determination to determine what their income eligibility is. Even though they may live together, be related, or whatever else, everyone's going to have their own individual household determination. They may be the same for everybody who lives together, but it also may be different. So if you're going to underline one section of this, I would say that last bullet is one to highlight. Generally speaking, MAGI follows the federal tax household rules to determine the household composition. For the premium tax credits, the tax household is always the household that we're looking at for eligibility determination. So that one should be pretty straightforward. And just to mention as well, people who are married must file together their federal taxes in order to be considered in the same household and get benefits. However, for Mass Health, we start out with the tax household. We look at those tax household rules, but then there's some exceptions that may apply based on family relationships and who actually lives together. So this is where things might change. Okay, slide 67. I wanted to highlight the Mass Health MAGI household composition elements. Like I mentioned in the last slide, we look to the tax filer and who they claim as dependents. We could stop there to determine the premium tax credit household, but for Mass Health, we then have to have a second consideration to look to see if there's any exceptions that may apply for the dependents. The main exceptions we look to is to figure out whether that dependent is claimed by someone other than a parent, whether that dependent is living with both their parents, but both parents don't file jointly. This is often the case when you have unmarried parents living together with the child. And the last exception is whether that dependent is claimed by an absent parent. If the dependent meets one of these exceptions, there's relationship rules that we apply at that point. We look to see who they're related to, who they're living with, and that's how the household composition is going to be determined. So you can see this is where it's not really as straightforward as the tax household. Just to note that married people are always included in the same household, regardless of how they file taxes or file taxes at all. And as you are all well aware, there's probably going to be a lot of people who will qualify for Mass Health that don't file taxes at all. And there's special rules that we'll look to for them, again, regarding how they're related to each other and who's living together. Slide 68, we go over the income piece of MAGI. We just talked about how to determine the household. Now that we know in whose household, we're going to look to see how much income there is. Just to to reinforce this message, we expect that people will benefit from MAGI income counting because this isn't gross income like it is today, and people are going to be counting less income that's otherwise counted, that wouldn't otherwise be taxable, and because when you add this all up, it's going to probably come out to be a lower FPL level. We think people should be benefiting from this, so that's a good thing to reinforce. MAGI takes taxable income, the taxable adjusted gross income, to figure out what somebody's income is, and then modifies it, that's the M part in MAGI, by adding back in some things like tax-exempt interest and Social Security income. Generally speaking, the adjusted gross income is found on line 37 of the IRS Form 1040, so that's the number we're going to be looking at mainly, with a few changes. Today, there's some things that are counted that MAGI will not count. So in the future, for Mass Health, MAGI will not count child support income, any pre-tax deductions like child care expenses or health savings account, things that are taken out of someone's paycheck ahead of time, workers' comp, benefits, gifts, inheritances, anything that's not taxable is not going to be counted towards somebody's MAGI, with the exception of some of the things we mentioned before, like Social Security income and some tax-exempt and some other interest that we want to add back in. Also, MAGI allows for people to take tax deductions from their income, and you can subtract that from what would otherwise be countable income. So if you have student loan deductions, you can take that out of your MAGI, and that would, again, lower your income. So that, we think, will benefit people in the long run. And those are the two main pieces of MAGI, the household and the income counting. And now I'm just going to pass it over to Dina to go over some of these other slides that relate to MAGI as well.
Okay. I'm going to take you to kind of the next section, which talks a little bit more about data matching and electronic verifications. It's slide number 69. One of the big differences with the Affordable Care Act is that it requires us to leverage electronic data sources to verify information and to streamline the application process. And this is really good news because we're going to be kind of dropping to paper verifications as a last resort. So if we're able to find from federal or state data sources that we can verify the information that you're self-attesting, we're no longer going to ask for paper verifications. Obviously, there's an expectation that somebody who self-attests to a particular income amount, we're not going to find an exact match for that income amount from our state and federal sources. So there is a policy within the federal regulations that's called reasonable compatibility. And reasonable compatibility basically allows us to see if the numbers are close enough, meaning the number that somebody self-attests to versus the number that we get from a data source. If they're close enough, then we will accept what the person has self-attested as verified, and we will not request verifications from that person. So the next two slides, which I'll talk about, get into just a little more detail about the reasonable compatibility process. So slide number 70 kind of talks a bit about the reasonable compatibility process for premium tax credits. And just to say up front, this is a back-end systems process. So this is something that you don't have to worry about. It's going to happen on the back end. Somebody is going to self-attest to what their income is, and we're going to look in the system at state and federal sources to see if we're able to verify it. So for premium tax credits, if the income that a person self-attests to is higher than the income from an available data source, the income will automatically be considered reasonably compatible, and we will take that self-attested income amount, and that's what will be listed as verified in our eligibility system. If the claimed income is lower than the income from the available data source, then they need to be within 10% of each other. So the self-attested number and the number from the data source need to be within 10% of each other for us for premium tax credits for somebody to be considered eligible without having to submit further paper verification. If they're not within 10% of each other, then paper verification, a VC1 request, which I'm sure many of you have seen, will continue to go out to request that information. Jump over to slide number 71. This just talks a little bit more about the Mass Health reasonable compatibility process. There are some similarities to premium tax credits, but also some differences. So for Mass Health, if the two numbers that come in, meaning the number that's self-attested and the number from the data source, are either both above or below a certain income threshold, we'll consider that to be reasonably compatible. And this kind of relates to the whole concept of coverage types, which I know is being talked about later. So for instance, if somebody self-attests that their income's 100% of the federal poverty level, but our data sources say it's 130%, we're going to consider those numbers to be reasonably compatible because we know that the person's going to be eligible for the same coverage type regardless. So we're going to put them in the same bucket, same coverage type, and say, okay, you're eligible, you're good to go. If, however, somebody claims the two numbers are not both above or both below, that's when we're going to drop to the 10% rule that's used for premium tax credits, which is that they need to be within 10% of each other, the self-attested number and the number from the data match. And if they're not within 10% of each other, then we'll drop to paper verification. One important note, which I've kind of said throughout, is in both cases, the self-reported income amount is the amount that's verified in the system. So if something's reasonably compatible, we're going to take the number that the person self-attested, and that's actually what's going to sit in our system as a verified number. Okay, so that's kind of the concept of reasonable compatibility, which again, the goal is for us to be able to ask for less verifications as often as we can. So for slide number 72, this talks a bit about non-tax filers and what happens if there's no electronic data match. Obviously, we know there's going to be many instances, particularly for the mass health population who are lower income, where people either don't file taxes or we're not able to get a data match to verify income. So for mass health, there's no change in the income verification process. We don't have a tax return or we're not able to get a data match. We're going to send out a request for information as we do today, the VC1, and we're going to ask for that income verification amount. For premium tax credits, that paper verifications can also be submitted as they are done today for mass health. The two important things to note, one of which Colleen mentioned earlier, is that married couples must file a joint tax return, and also that in order to receive premium tax credits, a person must file taxes for the premium year that they're receiving those premium tax credits. So if somebody's eligible in 2013 for premium tax credits, they need to make sure to file a tax return for that tax year. Slide number 73, just a little bit more detail about verifications and about how, people can still submit paper verifications as they do today, and that basically what we accept today, we're going to accept tomorrow under the Affordable Care Act. So pay stubs, Social Security letters, last year's federal tax return, pension award letters. Those same verifications that people send in now, they will continue to be able to send in the future to verify their income. The last slide just kind of provides an overview of some of the big differences. This is slide number 74. Some of the big differences between premium tax credits and mass health. As Colleen also mentioned earlier, premium tax credit household is always the tax household. Mass health does have exceptions to that in certain cases. Premium tax credits do require using projected annual income, whereas mass health still requires using a current monthly income calculation, which is business as usual, how we do things today. The other big difference is that some income that's counted for premium tax credits is not counted for mass health. For instance, lump sums. Lump sum payments are counted for mass health in the month they're received, but they're not counted beyond that. For premium tax credits, lump sum amounts are counted. Also, American Indian and Alaska Native distributions and certain scholarships and grants are counted for premium tax credit income calculations, but not for mass health income calculations. So that kind of goes over our overview of MAGI. I think we're going to turn it over to either Nikki or Paul to continue. Okay, or both.
Thank you.
So thanks, everyone. We're going to jump in, and we do want to leave some time for questions, but Paul and I want to provide you with an update from the recently recorded presentation on credits and subsidies. So we're going to just highlight some of the slides, and then we want to open up the call for any questions on MAGI or credits and subsidies. So if you flip to slide 3, the objective slide, we want to go over 4 key concepts. We want to touch upon the different types of credits and subsidies available under the ACA. We want to explain eligibility rules, explain how consumers can use premium tax credits, and then explain the reconciliation process. So moving to slide 5, Just want to bring your attention to the slide. This is a graphic that folks, I believe, have seen before. It's a yellow and blue graphic. But I want to make special note that probably not every time you see this, but as we've been moving along, we've been updating this to reflect our most recent policy decisions. So just want to make a special note, the item or the block that you're seeing in yellow represents the Health Connector covered members, and the items in blue represent Mass Health.
And this also is another form of the, we saw a slide earlier today that it was more like a bar chart with the horizontal lines, with the FPLs going out horizontally. This is it's another version of that as well.
Right. So if you turn your attention to slide 7, we want to focus on this, because this has changed really since the last time that we had explained it to you. We just want to make sure that we're being very, very clear about our affordability options, and very specifically about our connector care plans. So as you know, we've talked about the federal government and the Commonwealth together being able to provide eligible individuals with premium tax credits, cost sharing reductions, and other subsidies that can be applied towards the purchase of QHP. Remember, all of this is offered exclusively through the Health Connector. Premium tax credits. These are tax credits provided in advance, applied to a health plan's premium to reduce the cost for an individual or family, and these credits can only be applied to QHPs offered by the Health Connector. The next row down, mass premium and cost sharing subsidies, and you'll see in parentheses the connector care plans. Again, this is different than how we have presented in the past. Policy is involved on this, so we just want to make sure that folks understand that this is additional financial assistance to reduce the monthly premiums and out-of-pocket costs, and are applied to connector care plans, made available only through us. And connector care plans are subsidized from eligible federal premium tax credits and cost sharing reductions, as well as state subsidies. So in short, persons who are enrolled in connector care plans will be able to take advantage of federal premium tax credits, get cost sharing reductions, and take advantage of state subsidies. So individuals up to 300% of FPL. There is no here about aliens with special status. I don't know that we've spent enough time on them today, so just want to remind folks, remember our AWSS population. Those folks are, those who are lawfully present AWIS from 0 to 133 are eligible for a connector qualified health plan with a caveat. They have to be 21 plus. Other folks would be going to Medicaid. Okay. So I'd like us to move to slide 9. Slide 9 and slide 10, I just want to remind folks that this was covered earlier this morning when we talked about the eligibility criteria, but this is described a little bit differently, so this, when you're reading through the material, you might want to just hold on to these slides for your reference to explaining it to your folks. It's exactly the same, just looks a little bit different, as is slide 14. Now, going on to slide 11, someone had asked a question earlier today, really about premium tax credits, really how does it work and what can consumers do. So on slide 12, I just want to reiterate a couple of things. So typically, taxpayers have to wait until filing taxes to get tax credits. So these premium tax credits are a little bit different. So starting in 2014, these premium tax credits are available right away in advance of filing taxes. And those advance payments are actually applicable to the cost of their premium. So the taxpayer has a choice to make. They can take the tax credit in the form of advance payments. Those payments are made to the issuer or made to the health insurance carrier, the health insurance plan, to lower the monthly health plan premium. Or the taxpayer can claim the credits at the end of the tax year, similar to other tax credits. Really important for our consumers to know, for all of us to keep in mind, is that taxpayers choosing to take the tax credit will need to reconcile the payments on their tax return. Okay? So really, really important to know. On slide 12, an individual or family will apply through the mahealthconnector.org or through the HICS system to determine if they're eligible. We're going to estimate the amount of the premium tax credit that they're eligible for based on projected income. After the person shops for QHP, they'll have an opportunity to decide whether to take the full amount or portion or none of it.
And actually, this is Paul, just to add a little bit in there that, again, the system, when you're entering the information into the system, the HICS or MA Health Connector, it will be calculating, and then you would see the results, and you'll be able, you as a certified application counselor, if you're assisting someone, would see the options that are presented to you based on the information that's entered into the system. So again, you wouldn't need to do the calculating. We're just trying to give you the background information so you understand how the system will be working, so that you will then be able to just explain to people if they have questions. And the next slide actually just points out the three different ways that the tax credits can be used. Nikki's already talked about it, but that just wanted to point that out, that we did break them out separately in case you want to explain or need to explain to the consumers who come to you that these are their options and if they're eligible for the tax credits.
Okay, great. So let's look at slide 18 for a moment. So in terms of calculating, again, Paul mentioned that you're not going to be doing the calculation. However, we want you to understand how it's done. So the amount of the tax credit is based on the premium cost of the second lowest cost silver plan. That's on the Health Connector shelf of health insurance plans. As well as the individual or family's expected contribution based on their income, which is a percent of the household income a taxpayer must contribute based on their tax household FPL. So I personally like the graphics because that makes me feel like this is a simple thing that I can remember. However, if you move on to the next page, on slide 19, you can see a little bit more detail by FPL. So very specifically, you can see the individual's FPL level, and we're starting above 133 from the Health Connector perspective. You can look at the income amount, you can see the percent of income, the expected annual premium contribution according to the ACA, and then the expected monthly premium contribution to the right. Okay. Just a couple of things to point out. Residents below 133 that will be eligible for Medicaid are ineligible for tax credits. Okay, so you have, this is a good reference for folks to have handy.
Now, we also mentioned that before, that in the one of the earlier presentations we did, that the last point about residents under 133% FPL, that they would not be eligible, they'd be eligible for Medicaid but ineligible for tax credits. So again, we're repeating some of the information, so we don't mean to confuse you, but just want to emphasize very, very important information.
So we're going to skip the scenarios, so those we think you'll be able to do with your staff.
But I just want to point out on slide 22, it's the sample scenario for family. That actually is a very good example of multitask household, which is on slide 23, which we're going to talk about. Because, again, multitask, looking at slide 23, again, when multiple tax households combine to form a single coverage group, the premium tax credit values provided during the shopping experience may differ from the maximum values presented during the process of eligibility. Again, the system would be highlighting this for you as you are assisting a consumer with this. Again, the premium tax credit for each tax household in the coverage family is based on the relative share of the premium that's applicable to each tax household. And as a result of the relative share calculation, a tax household may not be able to use its full maximum premium tax credit as it's determined at the time of eligibility. They may also forego some premium tax credit in order to enroll in a plan with another tax household. I know that's a lot of words, but then on slide 22, there's the sample scenario with the family that can help explain what we're talking about. I think it might be easier for you because on slide 22 there's a lot of information on that, and actually this scenario came about. It was feedback from one of our constituencies that we got this example, so we thought it was very important to share with all of you because this is a real life scenario that was provided to us, and that explains very well what we just talked about for multi-tax households. Nikki, sorry.
So a couple of other updates we just want to bring your attention to are around reconciliation. So if you move to slide 26, we really want to be sure that folks understand this. So taxpayers who receive advance payments of premium tax credits will have to reconcile the amount that they receive based on their estimated income with the amount that is determined based on their actual income as reported on their tax returns. So this means that people whose income for the year is higher than they previously estimated could have to pay back some or even all of the advance payments they received. On the other hand, people whose income ends up lower than they estimated could get an additional credit when they file their taxes. So because of reconciliation, enrollees receiving tax credits are encouraged to come back to the Health Connector and update their income information anytime. You're not limited to open enrollment. You can come back anytime, update their income, whether it goes up or goes down, so that they can maximize their premium tax credit or minimize the amount that they have to pay back at tax time. I think that's a really important thing to note for our consumers. The next couple of slides, and actually again, 27 is really important to note as well. If the individual or family receives advance payments that are greater than the final credit amount for which they are eligible, the amount that they would have to repay would be capped if their income is less than 400% of FPL. So the caps range from $600 for married taxpayers, $300 for single with household income under $200, to $2,500 for married taxpayers with household incomes above $300, but less than $400. We have a hyperlink here to the IRS to get a little bit more information on this.
Actually, just so you know that the IRS, the reconciliation process is handled by the IRS at tax time.
Okay. So I'm going to jump, apologies for the speed, I'm going to jump to slide 35 and just look a little bit closer at connector care plans for a moment. I think we've talked this through, but this is where the content is when you're teaching your staff. We mentioned that, in addition to the premium tax credits in Massachusetts, people have an additional option of getting state subsidies. This is going to be through the Connector Care Plan. Remember, to maximize federal and state cost sharing and subsidies, this will only be done through the Connector Care Plan. Okay. So on slide 33, we've covered this. And I apologize, my numbers may be a little bit different than yours. But Connector Care Plans, again, we've looked at this, but just to reinforce, there will be a base premium tied to the income level if an individual chooses the least expensive plan. Cost sharing will vary by plan type, and individuals and families within a given income level will have access to the same co-pays regardless of the Connector Care Plan they choose. Those who choose non-Connector Care plans will pay higher premiums and higher cost sharing. You've seen the slide on, the chart on slide 33.
One that shows the Connector Care income thresholds of up to 300% FPL. We covered that this morning as well.
And slide 37 really wraps it up. just reminding folks that connector care plans resemble Commonwealth care plans. Remember, but it is a little bit different. Connector care plans do provide access to comprehensive coverage, and only certain health insurance plans are going to offer connector care plans. And after lunch today, other connector staff are going to go through more specifics on the connector care plans. So with that, I want to hand it over to Paul.
One more thing is
One more
after
thing.
the assessment page there, you'll notice there's a section called Apply for Affordability Options. Again, we've covered some of this before, but it's beginning on slide 41. When are the federal and state subsidies are going to be available? Again, it will be for the open enrollment, October 1st to March 31st. And then at the back, you'll notice starting on 44, there are some commonly asked questions. And then, again, the resources that are available online for you, as well as the other ones we've already discussed.